What I'd like to do in the next half an hour is walk you through two things, really. One is to help you understand where global economy is going and why, and where certain countries and areas of the whole planet Earth are actually moving, so that for your business you can try and prioritize geographic priorities. And second, I will talk a little bit about what our clients are doing, and we're actually working with more than 400 corporations at the moment, helping them expand their business internationally. And I'll tell you a few stories about what companies are doing at the moment to become bigger in international markets. This applies both to small, medium-sized companies, but also some of the large multinationals as well. One big business trend at the beginning that you should all be aware of. Competition globally will just get worse in the coming years for several reasons. One, large multinational companies, and we are mostly advising those, are all trying to systematize their international business. For many, many years, they were trying to do business via local partners, distributors, and some still do, and they had relatively small footprint in the markets outside of their home or outside of their continent. Most of our clients, when I go to corporate meetings, have their CEO walking into the room, strategic meeting, and he says, if we are doing 100 internationally now, how do we go to 300 or 400 in the next 3 or 5 years? And what do you need? They're moving at an incredible speed, despite the fact that we see softness economically in many, many markets around the world. So count on all your large multinational companies, competitors, moving deeper into all countries around the world in the next few years. Second element that will increase competition for you, that you should be aware of, is the rise of so-called emerging market multinationals. If any of you attended this 15 years ago, you would have noticed that there were not enough Chinese or Turkish companies or South Africans and so forth and the others. Today, just look around how many of those are attending this event, and competition is changing from that side very, very rapidly. We see more than 700 Chinese multinationals going global at the moment. There are a number of at least over 150 Turkish serious-sized companies that are going outside. All kinds of Asian companies. In our Vienna office, we recently had a delegation of 50 Brazilian companies who says, we have outgrown Brazil and Latin America. Tell us where else should we go? And I never heard of any of them, but they're all expanding globally and expanding their footprint and making investments. To my surprise, a week later, we had 30 Mexican companies visiting us as well. All of these guys are spending a lot of time and money going outside into the new markets and are very serious. And they're also moving very quickly as well. They're emulating your technologies. If you're a Western company from Western Europe or United States, they sometimes leapfrog it as well. And they don't necessarily form corporate committees before committing resources to a place like Nigeria or Colombia and other locations. They move incredibly quickly. So keep that in mind. And they often go to your customers and they will ask them basically, here's my product, would you like to buy it? And it's a 30% discount of what you're usually selling it for if you're a Western company sitting in this room. Every year I brief the board of a company called Tetra Pak, which many of you probably know, a Swedish multinational. And the last meeting we had, the CEO walk into the room and he said, he spent 90% of his presentation talking about competition, about how most of these emerging market multinationals are now completely have copied all of their technology and are going to all of their Brazilian, South African and other customers offering exactly the same product at a very good technology level already at a significant discount between 30 and 50%. So be ready for that type of competition. It's not going to go away. In fact, it's going to get much, much worse. They have discovered Middle East, Africa, and all of those locations. And if you don't move very quickly, they will capture those markets instead of you. The third element that you should keep in mind of rising competition are the so-called medium-sized companies from Europe and the United States, in particular from the developed world, who are stuck in sometimes low-growth markets of Western Europe, and they're basically, for the first time, expanding their export business. And they're very serious about it, and they're going out and signing up distributors and clients and so forth. If you belong to that group and you represent a medium-sized company out of Europe, for example, and you're sitting in this room and listening to me, I would advise you the following. I noticed walking around here, some of the stands are saying we have a global footprint. We are exporting to 50 countries and so on. Usually businesses like that fail. You don't go and expand into 100 countries all at the same time and signing up 100 distributors and you think you have an international business. It doesn't work that way. Usually it's not enough. 10 years ago, 15 years ago, a strategy like that was acceptable and you could have made money that way. Today, because competition is setting up local offices in most of the markets to help their partners and distributors, they're helping create demand and marketing activities. They're beating everybody else who is just relying on local partner to run the business for them. My advice to you, if you're a medium-sized company, you should rather select a small number of countries and do them properly, if you want to put it this way, with a proper level of investment, with enough resources, with enough local capabilities and competencies, and then you will find some success. Other than that, opportunistic international business is basically a no-go area anymore. It just doesn't work. Inevitably, what happens after a while, you're happy, you come home, you signed yet another distributor somewhere in Saudi Arabia or wherever it is, and then after 6 months or 9 months, they will call you and say, I don't want to order anything from you because nobody is demanding this product, and you need to create some demand. And for that to do it effectively and efficiently, you have to be increasingly on the ground and support those local partners. This is, by the way, only going to get worse in the coming years. The fourth element of rising competition that you should not underestimate are the purely local players, local companies. Companies that are family-owned, for the first time even thinking about going maybe to some additional markets, but usually they don't, and they stay in their local market of Poland or Turkey or Peru or Chile, and you go and you try and you think you can compete with your export business, but they already have all the right relationships. And by the way, banks are giving them money, unlike in Europe where bank lending is growing at 0.1%. In most emerging markets, bank lending is expanding at a tremendous rate, and access to finance for these companies is bigger than ever. They're doing IPOs, and actually many of our multinational clients say, we know how to compete against our large multinational companies. We are learning how to compete against the emerging market multinationals, but we are still struggling to find a way to compete against small family businesses that are aggressive, quick, with good technology, good product, and they actually have very correct and right relationships in the local markets. So keep those four drivers of rising competition for the next few years in mind. And I think it will just get worse. And in the end, those companies, you can think about your business and say, we have some wonderful technology here. We have developed it nicely. We think it's very competitive globally. But if you don't expand your sales to international markets in a proper way, either down the road somebody else will buy you or you will cease to exist as a business. So it's not enough anymore to have a nice set of products and technology. International expansion is absolutely critical these days, and doing it right is also critical. Doing it right, as I said, for medium-sized companies, I already gave you a couple of tips, but the ultimate thing is, do we have a business internationally that is sustainable, that it can grow year after year, that we can outperform competition? Is our business model, and think about your business in some of the international markets, is it resilient towards that rising competition? And are we locally relevant? Most of our clients are now trying to say, It sounds a little bit like a cliche, but in the end it's correct. Ultimately, the biggest winners in all international markets will be companies that are seen by locals as a local company. So doing all the right things in terms of investing in local infrastructure, local capabilities, local competencies, opening a few local offices and things of that kind, absolutely critical for success going forward. In terms of economic issues that you should be aware of, very important items here. First of all, we are still very much so living in the world that is a post-crisis world. The global recession was 6 years ago, and we still feel the impact from what happened in 2009. And we will probably feel it for the next few years as well. It's not going to go away, some of those aftershocks. If you think about 2009 as an earthquake in global economy, we are still in the mode of aftershocks. Luckily, there are some positive signs happening at the moment. And the good news is that the so-called developed world, the Eurozone, United States of America, and Japan are showing signs of economic life, finally, after not really doing much for the last 5-6 years in a serious way. For most of our clients, business in the developed world was very weak and only started really to recover in the United States last year, and everybody is hoping that this could be a turnaround year for business also in the Eurozone, which also showed a little bit of life in terms of corporate sales in 2014 as well. But the encouraging news, and just stepping back a little bit here, as you know, the reason why the United States of America is actually growing quite well at the moment, and it will probably grow between 2 and 2.5% this year. For the size of the market, this is remarkable. But the main reason for that is that they printed a lot of money in the so-called Quantitative Easing program, which, as you know, was $4.5 trillion in size. And basically what it did, it saved the banks because they bought garbage from the banking balance sheets and they gave them fresh dollars. And also, whenever Barack Obama needed any money, he wouldn't go to open markets like Greece or Portugal, but he would go to the central bank and he would get the money directly from them. This was important as a form of monetary easing, fiscal easing, and the size of it was incredible, almost, as I say, $4.5 trillion US dollars over the last 5 years. This program is now gone, but it has served its purpose. And everybody who said, hey, if we print so much money, it's going to create a huge inflation rate. Today, the inflation rate in the United States of America is 0. And so it really hasn't created any inflation, except in asset prices and share prices and things like this. But for day-to-day life, it has not at all. The other thing to keep in mind is that a similar program was done in the UK. The British Central Bank bought government bonds to the tune of £1 trillion, and this is why Cameron can now say into the elections going in and say, we are growing. He's growing because he had a friendly central bank, so whenever he needed any money, he would go to the central bank, they would print it for him, and he would do a fiscal stimulus program of some kind. Other than that, the UK economic fundamentals were just as bad as Greece in 2009. But UK didn't have to go to Frankfurt to beg for a bailout. Japan at the moment is doing exactly the same. They're printing money like crazy. And in fact, they want to double the money supply in 2 years, would you believe? This is similar, by the way, it would be the similar as if you would be flying with helicopters, many of them, above Tokyo, and throwing yen to the streets. The reason why they're doing it is that they want to escape deflation. And as you know, deflation is a very tricky thing, very hard to beat when prices start to fall. When prices fall, very few people actually go to shops because they always expect prices to fall even more. And the real value of your debt, if you're a corporation or a private individual, always goes up. So Japanese, after many years, have decided they're going to stop this deflationary spiral, and they're printing money. So the results are very visible. As I said, US growing between 2.5 this year, most likely. Japan will be around 1.5 in a best case scenario. and UK will grow around 2.5% as well. These are the best numbers we had since 2008. This is important because United States of America is about a quarter of the global economy. So if you're a European or any other exporter, your business in the US should be picking up. Companies in the United States are also sitting on more cash than ever. They have more than $2 trillion accumulated cash reserves, many of them only in your sector, and they will be expanding that in corporate investment. Similar things also in the UK and Japan. They have wonderful corporate reserves, and those reserves are finally being put to work and being put as an investment. This should mean for your business, these markets should be going upwards quite nicely in the next 2 to 3 years. This is good news. Finally, we also have some good news in the Eurozone, which last year had small growth of 0.9%, but this year, the way things are looking, basically, we are probably looking at 1.5 to 1.7, which again would be the best since 2008. So all of you doing business in Europe, this is also encouraging news. The primary reason for this rebound is multifold. First of all, monetary policy is very loose. Interest rates are at zero, which is good news in terms of lending, access to capital. On top of that, European Central Bank is finally doing something called a quantitative easing, which, by the way, is different than those in the United States, UK, and Japan. But it's still good news that it's finally happening after 6 years of debates. For 6 years, they were debating whether it makes sense to do it or not, while the others were doing it and getting out of the crisis. Finally, some common sense prevailed, and we now have a program that's running at 60 billion euros a month. By the end of September next year, the total money that will be created by the central bank will be about 1.1 trillion euros. This is, as you know, far less than what they did in America and far less than what they will do in Japan. But still, it has done several positive things already. First of all, just the news that the European Central Bank will print the freshly printed euros has already weakened the price of the euro. So if you're a European company, you are much more competitive in the last 6 months in global markets than you were before. So European exporters are certainly welcoming this cheaper euro because the euro was overvalued for a very, very long time. This is certainly not the case anymore. Second important point is that, as you know, the Eurozone was falling into deflation, similar to Japan. Prices started to fall. With cheaper euro, imports are more expensive, which means this year the Eurozone will have an inflation rate, which is good news. We don't want the deflation. Deflations are very hard to beat. The only thing you can do against deflation is print even more money. That's the only cure that exists in economics for deflation, really. So it's good news that now we are moving slowly towards prices rising a little bit. That's good news. Also, quantitative easing has made money cheaper for the governments to borrow. So even Portugal today, which was in a deep crisis over the last few years, today is able to borrow at lower rates than the United States. This is amazing. And it's already a result of the quantitative easing program, which also means that the governments of Portugal, Spain, and other markets, which were living in austerity, always saving and saving in the last 6 years, finally can say, we don't need to save so much anymore. We need to look at growth, and this is what they're going to do. So again, quantitative easing is helping that too. If you're a company that has, or you have your partners struggling to get loans in Europe, and this has been an issue for the last 5, 6 years, finally quantitative easing is helping here as well. Because the mechanism is as follows. It's not as in the United States. Here, the way it works is as follows. ECB says, here is my freshly printed euro, and they go to commercial banks, and they say, I'll give you fresh euros if you give me the government bond of Italy. And so UniCredit in Italy will give them a government bond which they're holding, and in return they will receive fresh euros. So commercial banks are selling government bond holdings, they're getting fresh euros, And the idea is that lending should start moving ahead and finally start growing. That's the whole idea pretty much behind the quantitative easing, and already we see first signs of lending to small and medium-sized enterprises happening in Europe for the first time in 6 years. This is all encouraging news, and if you scan through the European markets, you will see that places like, well, there's only one country in the Eurozone that will grow more than 3% this year, that's Ireland. Then the countries that will grow between 2 and 3 are UK, Sweden and Spain. The weakest ones will be Finland, France and Italy, which will be between 0.5 and 1%. And all the others will be somewhere in between, Germany, Austria, Netherlands, Belgium, around 1.2 to 1.6, 1.7, and Germany could be higher as well, coming closer to 2%, in fact, as domestic demand in Germany is picking up and corporate spending in Germany is picking up as well. So overall, this is the wrap-up of the developed world, if you want to look at it that way, and it's very encouraging after 6 years. Also, by the way, the Eurozone, Western Europe, is about a quarter of global GDP at market exchange rates. So US, Eurozone, Japan, this is about almost 60% of the world at market exchange rates, and it's growing for the first time, in fact, in 6 years. When we look at emerging markets, this is where we have more softness in the short term. Softness for our clients, where sales are still growing, but they're not as good as they used to be about 18 months ago. In fact, many emerging markets have slowed down at the moment. This does not mean, by the way, that you should neglect them. They are still the future for your business. This is where most growth will come from in the next 10 years, 20 years, and 30 years. If you look at purchasing power parity, the emerging markets are exactly the same size as the developed world today. They already buy half of the world's exports. They already buy more than half of the world's oil. They also have more than 80% of global population, and population in emerging markets is growing by 6 million people every month versus the developed world, which is growing at 300,000 people every month. And most of that growth of population in the developed world is actually in the United States of America, and it's mostly through immigration rather than actually genuine increase in population. So that tremendous demographic boom will be something that will be driving a lot of business going forward in the next decade and 20 years. We have clients who now have 10 or 20-year plans for developing business in emerging markets. You need long-range planning, because you cannot be thinking in emerging markets about the next 3 months or 6 months. It needs to be a medium long-term strategy. And the demographic numbers are tremendous. Sub-Saharan Africa will go from 1 billion people to 2 billion in 35 years. Only Nigeria, which has 180 million people today, by the end of the century will have 1 billion people, by the way. It will be the same as India today, or it's almost coming to that level. There are other places like this. In Asia, we will go from about 4 billion people to roughly 5.5 billion. So another 1.5 billion will be added in Asia. And even in Latin America, in the next 35 years, there'll be 250 million people more. This is where most of the demographic boom will happen. And Middle East as well, of course, will increase. While Europe will go from 630 million today to 530. And that's the only place in the world where population will keep falling. This is important in terms of prioritizing where you want to go and prioritize the business for the medium-long term. So to give you a quick snapshot, many headline news today, when you open the newspapers, they're talking about emerging markets as something that is disappointing or relatively negative at this stage. But in reality, the reality is much better than the headline news are suggesting. Yes, we are in a temporary cyclical downturn in many of them, but economic fundamentals are very good. And this is what I always look at. It's very important. If you look at emerging Asia, which, by the way, for typical corporation accounts for 15 to 20% of global sales, sizable part of the world. In the next 3 years, it will be growing at around 6% GDP, real GDP growth. This is 3 times quicker than the developed world, and it will continue like this most likely for quite some time. Yes, China is not growing 8 to 12% that it used to. They are reporting 7% at the moment, which probably is a little bit less than that in reality, maybe 6.5. But this is still among the best growth rates that you can find anywhere in the world. India is picking up as well under the leadership of the new Prime Minister Modi, and they will go to about 8% growth in the next few years. Already this year we will be coming close to 8%. The others, Indonesia, Malaysia, Philippines, Singapore, and the others, they're all recording very nice growth rates. But as I said, the fundamentals are very important. If you look at the accumulation of foreign debt, which is a problem in many peripheral markets in the Mediterranean, for example, if you look at the entire emerging Asia, the total accumulation of foreign debt is barely 17% of their GDP, 1.7. It's the lowest in the world, in fact. They don't have to deleverage. Their companies, they don't have to deleverage as much like we have in Europe or in some other locations in Eastern Europe. Their government debt is half of the levels that we have in the Eurozone. Their record amount of foreign exchange reserves is just incredible. In emerging Asia, they have a record amount of more than $7 trillion of foreign exchange reserves. So even if some currencies fall, they have enough money to protect them and defend them if they choose to do so. This is not Asia 1997 when everything went to hell. It's a very different position. So for our clients, this is the #1 priority where they are putting business development money. This is where the highest growth is, this is where the highest growth will be, and this is where also huge demographic boom will happen. And there where competition, as you know, is exceptionally tough and difficult. In the Middle East, which is getting more than its share of horrible negative headlines, business is still good. For most of our clients, everybody is growing at least in high single digits or in double digits. Yes, lower oil price has reduced a little bit the quickness of growth, if you want to call it that, but at the same time, it's still very solid. The good news, despite the fact that oil price is much lower and affecting your business in the Middle East, the truth is they have more money than ever in their history. Saudi Arabia, would you believe, is sitting on over $700 billion of reserves. It's an all-time high, 700 billion. Abu Dhabi, just one of the Emirates in the UAE, is very close to $1 trillion, similar to Norway. Kuwait, 500 and something billion. Qatar, almost 200 billion in sovereign wealth funds and reserves. Record amounts. This is why they are saying, Saudi Arabia in particular, we don't want to cut production of oil. In fact, we are increasing it. We can make and produce oil at under $7 a barrel, and we don't want to cut production to keep the price high. We want to price out all the expensive players from the global market, like shale players in America. And they can use the reserve for the next several years to cover any budget deficit. So business is still good, and the fundamentals there are very solid. They don't have much debt, and most of our clients are still doing very well, as I said. And even you have rising markets like Morocco, Egypt now as well, in MENA region, also looking much better. And if Iran opens up in a serious way, then you will see added opportunities in that part of the world. In Eastern Europe, things are more complicated, and many European companies very active in East European markets. But the good news, first good news on Eastern Europe, is that Poland, Czech Republic, Slovakia, Hungary, Romania, the Baltic states are growing between 2.5% and 3%. This is again the best since 2008. It's picking up. Europe is helping them a little bit. Lending is coming back. They have deleveraged heavily over the last few years, and we see a nice pickup in business in those core Central European markets. Things get more complicated further east, where Russia is in a recession, and it will be this year, and it will not be over soon, by the way. This is not a short-term crisis in Russia. It's a chronic geopolitical game which could go on for several years. One of our big German clients, I was with their board last week, and they basically said, we think this is a 10-year thing. Russia will not bounce back quickly, and they're looking at how to restructure their business in a serious way. Ukraine, economically, will also be struggling big time, and they will have all the time problems because the West will not help them enough. The only thing Ukraine will get is some little bit of IMF money to stay alive. So business in those two markets, Russia, Ukraine, will be very tough in the next at least 2 years and maybe longer. Kazakhstan as well, which was very strong growth for most companies, is barely growing at the moment because oil price is low, and some other CIS markets are also much softer. So almost two pictures in Eastern Europe, and Southeast European belt from Slovenia down to Greece is still very stagnant and barely moving, and I don't think it will be bouncing back anytime soon. In fact, that part of the world will be one of the weakest emerging markets in the next few years. And finally, on Latin America, if any of you have any interest in business in that part of the world, things have fundamentally changed there as well in the last few years. What we are seeing is that economic fundamentals are very good in the key markets of Brazil, Mexico, Colombia, Peru, and Chile. This is where most of our clients are doing business. That's not bad. And business is very soft at the moment and difficult. Brazil is entering a recession. Mexico is growing 2.5% as we speak. And also others have slowed down because commodity prices are much lower than they used to be. Latin America is very dependent on commodity prices like Africa. So the moment the cycle of commodities goes down, Latin America always suffers. But also, as we know, commodity prices will bounce back. As Europe starts to need more commodities, and same as United States, commodity prices will be rising yet again. And there will be another cycle, and that will mean also much better business for you in the medium long term in the Latin American markets, including those that are not as good as they used to be a few years ago. The really weak markets that are sizable for business, Venezuela, Argentina, I don't think they will change to better. Venezuela is going down the drain and Argentina is going in that direction as well. So I think the corporate focus will stay on those 5 markets rather than anything else. And if any of you have interest in sub-Saharan Africa, which, by the way, for most companies accounts for less than 2% of their global revenues, many companies are designing proper Africa strategies for the first time, and they're usually looking at 3 big priorities: South Africa, Nigeria, and Kenya. And then on top of that, they're looking at maybe other 8 to 9 markets, mostly Ethiopia because it's big, 90 million people. And then in the West Africa, usually it's Senegal, Cameroon, Ghana, and in the East also Tanzania, Uganda, Zambia, and also in the West you can argue Angola. And that's about it. I don't have clients who are going wild about Burundi or Burkina Faso. So usually that's where the corporate focus in Africa is. It's getting more competitive. Companies are growing in good double digits, but of course currencies are under pressure because commodities are down, and of course Africa is now going through that difficult period in the short term when commodity prices are cheap. And when they bounce back, many African markets will bounce back again. So it's a long-term play for business, and you should look at it that way. Last point, which might be of interest to you, is the issue of commodity prices, which of course we had a peak and now in a decline. Many prices are, as you know, 40–50% cheaper than they used to be, not so long ago, but a year ago. And just to explain what's going on in the commodity markets, just based on one example. And if I look at oil, which is, by the way, half of all the commodities traded in the world today, it will maybe give you a little bit of insight into how oil markets actually work, because it's such a huge problem for everybody trying to predict it. Your business is sometimes dependent on it. You're buying raw materials which ultimately are dependent on it as well. So if you look back, and this is an interesting example, if you look back in 1998, oil price was trading at $9.64 a barrel. $9.64. For 5 years after that, it was trading at 20 to 22. And everybody said that's the real oil price. It shouldn't be higher than this. All the forecasters were saying the same thing. Then what happened is that the financial industry started actually to take an upper hand in terms of pricing of commodities in general, but including oil. So the invention of the so-called ETFs, the invention of hedge funds going into financial speculation with oil futures, for example. It resulted in the fact that today the oil price and many other commodities are not priced based on their supply and demand. They are based on the oil futures market or the futures market for other commodities. So in the oil business, oil futures market today, as we speak, is about 6 times bigger than the physical market that we can touch and use. So the betting, it's like a casino. They bet that oil price will go up, and it does go up. And in the middle of 2008, as you know, we went to almost $150 a barrel, from 20-something within 4 years. Then we dropped to $30 a barrel in 2009 during the global crisis within a scope of a few weeks. And then Merrill Lynch came up with a paper and they said, we told you all along the oil price should not be more than $30 a barrel. Then Arab Spring happened and then oil price went to 80. When Israel said we are going to bomb Iran, that's when it went to 100, 115, and it stayed there for a few years, which was very convenient for you if you had your sales in the Middle East roaring well and business fantastic. But, of course, the story changed in the last 6 months, 9 months, with oil price going from 115 to 45, and now it has crept up a little bit. For me, the funny thing is that between 98 to today, the annual increase in oil price has been only 1.4% a year. It has nothing to do, the oil price has nothing to do, like many other commodities, nothing to do with the real supply and demand. It's a financial speculative gain. Most of these traders are also high on various drugs, by the way, which is another thing to keep in mind. I'm being recorded, so I'm not going to say more than this. But there are all kinds of things they're doing, by the way. If you watch the movie The Wolf of Wall Street, these are the people, kinds of people that are trading commodities as well. It's highly unpredictable where it is going. But one thing you can bet on is that prices will rise again, because as developed world is growing economically and they demand more raw materials for manufacturing and everything else, copper prices will rise, steel prices will go up again. It will maybe take a year or so, but of course it will down the road be something that you will see rising gradually, especially as the global demographic goes from 7 billion people today to 9 billion in about 30-something years. So the need for various types of commodities will go up and prices simply gradually have to rise. So I just wanted to leave you with that last thought on the commodity prices, how unpredictable that is, and to wrap up to say that if you think about it, what I told you today, developed world is growing, good news. Most emerging markets are growing except Southeast Europe and Russia CIS, which also is good news. Maybe Brazil, of course, this year, but the others are all in a nice plus and growing and expanding nicely. So I would advise you, I don't know what your sizes are, what kind of companies you represent, but going international in a proper way is more important today than it has ever been. Having that depth in those local markets with the right product portfolio, with the right people, with enough upfront investment, rather than expecting returns overnight, and don't rely only on your partners and distributors to build a business for you. I leave you with this, and to last final point, just as a little joke, I don't know anything about electricity business or electrical stuff. The only thing that I have linked to this is that my mother was born in the same village as Nikola Tesla, and this is not a joke. Good luck with everything, all the best. Thank you very much.